Hello, everybody. Welcome on this beautiful Wednesday, I think it is. Yeah, it's Wednesday. To another one of our awesome webinars. We're super excited today. We've got special guests, the one and only Ruth King. She's done a lot of really cool stuff. I'm gonna not butcher her introduction because honestly, she's way cooler than anything I could say out loud. We'll jump into this thing in a second. First things first. Want to make sure that we that we drop a couple different things in and just kind of like set up some of the usage of this webinar platform. The way you guys can help interact with us is we have two sections. One is a chat section, the other one's a question section. Honestly, you guys, today we're really just going to be focused on using the chat section. We'll also be dropping in a poll here or there. I think there's really only two polls. We'll drop those in just a second. But first and foremost, for those of you who are already actively listening to us, do me a favor in the chat section so I know you guys can both hear us and we're coming across as loud and clear. Drop in that chat section where you guys are joining from, what your business name is, and then on top of that, let us know what vertical you guys specialize in. You know, are you guys HVAC, roofers, etc.? Like, we'd love to just understand what you guys are actively doing, and we'll go from there. Yeah, awesome. Thank you guys for dropping that in. I'll do a couple call outs. Peter, Doug, Betty, Cindy, welcome. Super excited to have you guys here today. So awesome. Thank you guys for doing that. So what we'll do is I'm going to jump in real quick. And first thing, we're going to go through some intros. Obviously, you want to know a little bit about who Ruth is, and then I'll give you guys a little understanding of who I am and who Hearth is if you're not actively already using us. But we'll then jump into all the other core content that Ruth is just an expert at. So again, a lot of people pay her a lot of money to come in and do this for their organization. We're super excited to have her helping us out today and bringing a lot of this content to you guys. So without further ado, I am going to shut my mouth, pass it over to Ruth. Ruth, tell us a little bit about yourself, and we'll go from there.
Thank you, James. I really appreciate it. And thanks to all of you for joining us today. I'm president of Business Ventures Corporation, and I've been working with contractors since 1987. So you can see all the gray hair I've got. And I jokingly say it's because of all the work that I've done over the years. But my goal in life is to help give you the tools and processes to get and stay profitable and build wealth so that you can do pretty much what you want to do. It's, we can build the profitability, but profitability for what? The reality is we have to have something in addition to the profitability and building the wealth, because doing those two things will stabilize your company, and then what's after that? But anyway, my goal is to help you do this, and I am so excited to be here for this particular webinar, and thank you to Hearth for allowing me to do this. And James, if we have a second, I want to tell you how I got how I found out about Hearth. One of my clients said to me, "Do you know Hearth?" And I went, "No, who are they?" And he goes, "They're this really, really great company, and it has helped us with financing so much, and we now have the opportunity to give customers the lowest possible pricing number, and we are winning more and more and more jobs as a result of it." So I had to go dig, and I talked with the people that were their direct contacts, and I talked to Noah, and I talked to James, and Hearth is really cool. So what we're going to do today is we're going to look at different types of pricing based on what Hearth can do for you versus what everybody else can do for you. And I also want you to keep a really good open mind, simply because I price differently than just about everybody else. And I do it by dollars, not by percentages. So I've written 5 books. Profit or Wealth is my last book. And I've also written The Courage to Be Profitable, which is its prequel, and 3 Ugly Truth books about business. And I've been around for a while. So James, that's a little bit about me. Did I give Hearth its due?
You did. And one of the things you guys were going to do real quick is we're going to drop 2 polls in. In the meantime, while you're answering these polls, the first one is really just getting a better understanding of exactly how you guys are actively pricing internally. So you should see that poll jump up real fast. Do us a favor, pop in there and answer that question. How are you guys pricing? If you guys can't see it, there's also a polls tab that you can click on. make sure that you do us a favor. This helps us, again, just gear the content toward exactly what you guys are currently doing. So like I said, I can see visibly how many people are on the webinar, and it's definitely more than are answering the poll. So do me a favor real quick. I'm gonna bug you guys for another like 10 seconds. Just jump in there super fast. It's one click. Thank you for somebody clicking on the third one, which is something we like to throw in as a little humor, that you've done this long enough that you can look at the house and know exactly what to do with it. So again, thank you guys for doing this. The other poll we want to do too, and this helps us a little bit from the Hearth side of the world. I manage all of our channel partnerships as well as our channel marketing. So really what Hearth is intending to do is, we know that when you don't charge dealer fees, it's a hell of a lot easier to be more accurate when it comes to where you price and how you price, because you're not layering in a bunch of arbitrary fees. Plus, we give you the control, especially with our payment functionality, which if anyone is on this call and is an active Hearth member and you're not using Hearth Pay, you're going to want to after this, because it gives you the ability to then shave as many other options, or excuse me, fees from the sales process as possible. So the other poll that we have up there that I'm going to throw on, and again, answer it as we go, you guys, is, are you actively offering financing? There's three options. I don't, I do, and it's with somebody else, or I do, and it's with Hearth. So again, do us a favor, answer that one super fast. Thank you guys for being way faster on this one than you were on the other one. And then we'll jump straight into the content. But again, you guys, we're super excited to talk about this today, because it's honestly one of those topics that doesn't come up as much as it needs to. So many people look at this and go, I know exactly how to do this. As a point of reference to my background, is I come from management consulting, working heavily within the tech and analytic space, a lot with private equity firms, et cetera. So again, this is music to my ears that we're doing this, because I'm an operational nerd, but excited again to jump through. So we got enough data on there. Super excited to get this thing going. So let's kick this off. So Ruth, I'm going to pass it back over to you. Let's dive straight into the content.
Okay, so this is the Hearth screen, a little bit about what Hearth does. And it really and truly allows the customer to have choices, rather than, okay, we have 12 months same as cash, or we have, you know, a special pricing for financing or something like that. This way the customer can actually choose what is best for his or her budget. And as a result of that, they feel more confident knowing that they're getting the best price they possibly can from you. And then they can choose whatever, you know, monthly payments they want, and all that type of thing. So you're, for all intents and purposes, taken out of that particular decisions. They know that the absolute bottom price for whatever they're buying is the price that you are giving them. Now, we're going to talk about what that bottom line price should be. So keep an open mind, because again, I don't do anything by percentages. I don't do anything by gross margins. So I look at actual numbers. And once you try doing it the way we're going to talk about it, you're probably, number one, going to know exactly, you know, how much money you're actually making, and number two, be able to make decisions in potentially slower times of the year to increase or decrease your net profit per hour. So with Hearth, you can very easily do that. So James, next slide, please.
Yeah, and before we jump to the next slide, the only other thing I want to say, you guys, is Hearth is an incredibly data-driven company, and we have a lot of really cool partners out there that give us access to a lot of other market insights. And the one thing that we have seen again and again from a lot of our lead generation partners, you know, and these are the guys that are creating, you know, hundreds of thousands of leads a month for home improvement jobs, regardless of what industry you're in, HVAC, roofing, you name it. Biggest thing to understand is the number one reason why somebody purchases or does not purchase is price. It's not reviews, it's not word of mouth, it's not anything. The number one reason why somebody chooses the contractor that they do is because of price, period. So moving on.
Cool. All right. So most of the pricing models are really wrong, and they're truly wrong. And I'm going to talk to you about, you know, James and I jokingly said, okay, you go to the curb and you say, okay, this is X number of dollars. I've done this 27,000 times I've been in the industry for X period of time. But you could have been in whatever industry you're in for 30 years and be pricing wrong for 30 years and losing money. And I'll give you an example. I had a client who started a business with his partner, and they were really good at what they did. And they grew the business from 0 to $2 million in 12 years. And they hit the $2 million mark and they stopped growing. And not all of a sudden, but they slowly started to see that they couldn't take their discounts. Occasionally they had problems paying payroll, and they're like, we're a $2 million company. We've never had to worry about this before. And they were smart enough to pick up the phone and call me. And to make a very long story short, they were losing a nickel for every dollar they took in the door for 12 years. So you might be in the same situation right now. And you ask, well, how does that happen? Well, growth masks a lot of problems, because the cash from one job starts the next job, and the cash from that job starts the next one. And as long as you are growing, the cash is always increasing. But in this particular case, it was increasing, only a nickel or 5% less than it should have. So you're not going to see that as you grow. I hope that this is not happening to any of you, but with this pricing methodology, you will be able to actually see what your job costs are and what you really should be charging for the jobs. And I need to tell you another really funny story, James. I know I'm into stories. It's not funny. I started using with a brand new client, an electrical contractor, who was always, well, they won't pay that, or they won't pay that. That was his mindset. And I said, okay, here's your overhead cost per hour. Here's the net profit per hour you want. And I'll explain all this as we get through this. And he said, so I priced the jobs. And he goes, they won't pay that. I said, call them. So he did. And the customer said, yes. And he looks at me. I said, okay. And he had another one to do that day. And I said, and we priced it. And he goes, he didn't say the customer wouldn't pay it this time. It was like question marks in his head. The customer paid it. And every single job he has priced since we started this new pricing model, he has actually won. Now, we're only a week into it, or maybe 10 days now. So I'm sure somebody's going to say no. But the reality was, he had in his mind that he couldn't charge that much. And he was very good at what he did. He provided high quality work. He took care of his customers, and people will pay for that. So they think about price and you think about price. But the reality is, if you provide the quality, you can charge for that quality. All right. So James, next slide, please. All right. So what we're going to do is we're going to start at your desired net profit per hour. Basically, we're taking our P&L and we're turning it upside down. We're going to start with what we want on the bottom line. We're going to add our overhead cost to it. Then that's our direct. Then that's our gross profit. And then we're going to add our direct cost, and then we arrive at your price to your customer. And so that's how this pricing model works. You'll notice there's no percentages. You'll notice there's nothing other than dollar amounts in this pricing model. All right, next slide, please. All right, so one thing I want you to understand before we get through this is markup is on cost and margin is on sales. For some of you, this is you've been drilled into your heads. But I still hear people saying, I'm going to mark this part up by X number of dollars. I'm going to mark up this material by X number of dollars. Markup is a misnomer. So markup is only on the cost of that product or the cost of that material. Margin is actually what you're actually earning on the sale of that material, rather than just necessarily the direct cost. Okay, next slide, please. And then, so what we're going to do, if we want markup, we're going to calculate your cost, how much markup you want, and then go from there. So if you want a 40% markup on a $25 part, you multiply 25 times 1.4, and you get $35. So you do 1 point, whatever the markup you want, times the cost of the part. So on the next slide, you're going to see what margin looks like. All right. So if you want a 40% margin, you divide by 1 minus the percentage. So if you want a 40% margin, you take $25 and divide by 0.6, and we get $41.67. And here's why. We have a wholesale is 100%, and we have 40% left. And for those of you who remember your 7th grade math, and I know for a lot of us, it's a long time ago, it's 100% started, we have 40% left, so we had to use 60. And you make that division, and that's why you do it that way. All right, so let's see what this really does. All right, on the next slide, you can see the differences. $35 part, the cost of sale was $25, our gross profit was 10, and we take 10 divided by $35, and that's a 29% markup. It should be a percentage sign. We both missed that. You think you're marking up 40% and you're making 40%. You're actually only making 29%. So the reality is use the margin method, and that absolutely does work rather than just marking up your parts. Okay, next slide. All right, so, even if we're using margins, you are still going to get in trouble by dividing by 1 minus the gross margin to price your products, and here is why. So let me go through this next slide, and you're going to see a whole bunch of numbers on the slide. When I start working with a new client, I go pull 20 of their jobs, and this is one client's 20 jobs. It starts with the initials of the customer, the selling price, GP being gross profit, GM being gross margin, OH per hour is overhead cost per hour, the number of hours on that job, the net profit, and then the net profit per hour. The net profit is simply the number of hours times the overhead cost per hour, which we will calculate, and divide and subtract that from the gross profit. Net profit per hour is just net profit divided by the number of hours. Okay, so on the next slide, I'm going to show you two things about gross margin. So you'll notice the one I highlighted on top, we had a 40.51% gross margin. And if you go down to the one, HT, we had a 40.27% gross margin, about the same thing. I mean, all right, you can quibble, about less than the 0.5%. It's about the same thing. If you look over to the right, the first one, they had a net profit per hour of $73.83. And in the second one, they actually paid the customer $21.68 to do this job. Same gross margins, one made money, one didn't. So this is why gross margins do not matter when you are pricing. What matters is what we're going to talk about with overhead cost per hour, and what matters with net profit per hour. So go to the next slide, and I want to show you something else, which is really cool. So the one that's highlighted on top, we got a 64.5% gross margin. We think, terrific, we did phenomenally well. Well, that's only $49.95 net profit per hour. And that very first one, where we had a 40% gross margin, we made $73 an hour. And then we had two below it, the 19.41%. And you think, oh gosh, we lost our butts. And we actually made more than we did on the 64.5% gross margins. So gross margins do not matter. All right. What we're going to do with overhead cost per hour and net profit per hour are the two things that matter. All right. Next slide, please. All right. So if you're doing markup or you're doing margin, you are not taking overhead into consideration when you're calculating your selling price. There's a pricing methodology out there called gross profit per man day. It's still not good because it doesn't consider overhead. And the way I look at it is, let's assume we have two jobs that are each $10,000, one of which takes 30 man hours and the other which takes 5. Is it fair to charge both of those jobs the same amount of overhead? No. The job that has 30 hours should cover more overhead because it's taking more people, it's taking more this, and it goes on and on and on and on, than the one who has only 5 hours on that job. So that's why you look at overhead and what, based on labor, how much labor do you have? What's the overhead cost per hour there? All right, so let's do the next slide, please. So what we're going to do is we're going to start at your desired net profit per hour. Then we're going to add our overhead cost per hour. Then we're going to add our direct cost, and then we're going to arrive at the price to the customer. So we're going to do this step by step. So the next slide will start this process. The overhead cost per hour is just defined as, for each billable hour, how much overhead you have to add to determine net profit. So you take your total overhead divided by your number of billable hours. Now, here's the key. What were your billable hours? And if you've never priced this way, we're going to sometimes be using a dartboard the first year that you're doing this, or the first couple months, because you don't have a clue. But, let's assume we want to estimate it where you might be. And so we can look at last year's, we're in January of 2021. We can look at 2020 year to date, the entire year of 2020, and we know what our overhead cost was for the year. All right. So that's there. Now, how do we calculate our billable hours? Well, most payrolls now, you'll have to put in the number of hours, the type of hours it was, i.e. was it vacation, holiday, or, quote unquote, regular or overtime hours. And then it will calculate what the paycheck should be for that particular person. So if you take the total number of hours that that person got paid, subtract out vacation, subtract out holidays, subtract, and those two things, and subtract out any meeting time or training time or something along those lines, you'll have the idea of the most number of billable hours. Then you have to look at and go, okay, did he really or did she really work those number of hours? And the answer is probably no. So on an average payroll, I mean, how many, if you've got 40 hours in a week on average, never mind overtime for right now, how many of those hours are actually billable to a customer? That's what you want to figure out. So looking at your billable percentages will give you an idea of what your billable hours were for last year, and divide the two together. You'll see what it is. All right, next slide, please. Net profit per hour is basically the same thing. And this is really easy to do once you've got your billable hours. Look at last year's net profit and you divide that by your billable hours. And if it's, the way I look at it is, if it's less than you can make at McDonald's or a fast food restaurant, why are you putting yourself through this? You know, why are you running a business? It's, you know, life's too short. I mean, there's a lot of stress. There's a lot of dealing with employees and everything else like that to make less than $10 an hour. That doesn't make sense to me. So that's the two things that we use. And if we take it to the next slide, then here's some things that we're going to do a pricing model now for you all. And if you would like the pricing template that we're going to talk about, just send me an email and I'm happy to send it to you. My email address will be at the end of this. So let's assume that we want $100 net profit per hour. And let me go back to that electrical contractor that I was talking to you about. We priced him because he was, his net profit per hour came out to be about, when I did the numbers, about, I hate to say this, about $10 an hour, and I'm not going to go any further than that. And the reality is, if you want to go from 10 to 100, it's not likely going to do a whole lot. What we ended up doing is we took his pricing for construction and pricing for replacement jobs to $30 net profit per hour, because that's basically a three times thing. And we took his service up to $75 an hour, which is a lot easier. And $75 an hour is pretty much the national average for service type: plumbing, electrical, HVAC, pool and spa, roofing, you know, whatever it is, that's generally where it is. So we had $100 net profit per hour. We calculated overhead cost per hour to be $54 an hour, 10 hours to complete the job, $1,000 equipment cost, and $60 in material costs. So that's what we did with respect to this particular pricing module. And you can put in any number that you want in terms of doing it for real for you. So let's go to our next slide. And what we're going to do is we're going to do different scenarios. We're going to do a scenario with a 5% buy down, and we're going to do a scenario with, as you can see over to the right, what we'll end up doing is we're going to do three things. We're going to do, if the customer pays by check and there's a commission of 10%, i.e. the customer is using Hearth. If the customer is using credit cards, they can still use Hearth, but they're going to pay you because they want their points. So in my book, I don't trust customers to say they're going to pay you by cash or check, because they whip out their credit card and you're out 3%. So I almost always price everything with a 3% credit card. And then a financing buy down, depending upon what it is, we're going to go through different scenarios. So basically all we're going to do is we're going to take our 10 hours. We have $54 overhead cost per hour. Our labor cost is $36 for 10 hours. So we've got $1,000 for equipment, $360 for labor, $540 for overhead, and $60 for material costs. Add them up. So our total cost is $1,960. Our tax at 7%. And in this particular situation, I taxed only materials. It was $74.20. Our net profit per hour, we wanted 100, so we're adding $1,000 to it. And so our total raw cost, before we get into any of this financing buy down, is $3,034. All right. So if you have no commissions or anything like that, that's what the price you would give to the customer. If you have a 10% commission, you would give the customer $3,371. If you want to pay a credit card fee and include that, it would be $3,476. And if you have an 18% buy down, it's our dealer fee, however you want to call it, you're going to charge the customer $4,111, assuming that somebody has to pay that, and it's generally the customer. So, you have two options here. You're going to the customer and say, Mrs. Jones, the investment you make in whatever it is $3,371. And your competitor over here, who knows he's got an 18% buy down, is going to give the customer a $4,111 price. I mean, that's, $800 difference. Which is the customer going to choose? Obviously yours, because you're probably going to give them the same thing. You've provided the quality, you've provided the service. And as a result, it's an $800 difference that they don't see the difference in, and they're going to choose your price. And then they're going to go to Hearth and they're going to choose their financing. So that's really a good explanation of why we do it this way, and let the customer choose the financing. Full disclosure, she knows what the price is. It's not any of this funny stuff. Quite frankly, I would add the credit card fee, and if it were me, I'd give her the $34.76 versus the $4,111. So, it's $100. I mean, it's $700, but it's still significant to the customer. And that's why we priced like we did. All right, so next slide, please. All right, so no dealer fees or anything else like that. No credit card fees or anything like that. So the Hearth price is $3,371. We add credit card, it's $34.76, so $100 more. 5% financing fee, it's $177 more on top of that. And if it's an 18% financing fee, it's $740. So if you're dealing with financing companies who are charging you an 18% financing fee, why? I mean, you can see the difference right there in terms of being able to do it this way versus doing a buy down fee or a dealer fee or something along those lines. So that's the difference in pricing in terms of looking at it from an overhead cost per hour standpoint and a net profit per hour standpoint. You'll notice we did no margins. We started at the bottom. We figured out how many hours were in the job. We wanted $100 net profit per hour, so we added $1,000 profit to the job. We knew our overhead was $54 an hour, so we added $540 in overhead. So right now at the gross profit part of it, we're at $1,540, and we keep going, and you add all your direct costs on top of that. And the template has it. So that's essentially how you price. It's not mysterious. It's not hard. We all have a calculator, right? I mean, it's not like we have to go and scratch our heads anymore, but we have to figure out what our overhead cost per hour is, and we have to decide what we want for net profit per hour. Once you know those two things, go for it. So next slide.
And the one thing I will say, you guys, too, before we go to the next slide, I mentioned and alluded to this earlier, the payment functionality within Hearth. The Hearth, one of the neat things that you can do is, Ruth had mentioned, credit cards. The reality is, a lot of people love the idea that if I have that cash sitting in my account, and
James, you're breaking up.
Okay, I'm just gonna keep going.
Okay. Yeah, I mean, the functionality really and truly is really, really good with respect to, you can choose. The customer gets to choose whatever financing package he or she wants. It really is a situation that way. And normally, Hearth is the first one that I actually saw like this. It's, we're looking at all these disruptive things in our industry, and this is actually one of it. Why should you have to hide a buy down fee? Why should you have to hide any of these things? And you can be totally transparent with the customers. So, there's lots of different things that you can do this way, and go play with it. It's a very different way of pricing. It's not markup, it's not margin, and it's actually kind of fun to see where you're going from there. So if you have questions, if you want the pricing templates, I do a class, an online class starting on Monday called Make Your Financial Statements Fun and Sexy, which I'm happy to send you the information about too. It's agnostic in terms of plumbing, electrical, heating, and air. I mean, we're all contractors in here, and we all can use that type of thing. Office number 770-729-0258, cell 678-296-4123, and send me an email, rking@ontheribbon.com. So I appreciate your time today. We wanted to make this short for you so that it would only be a half an hour, but I wanted to open up your minds to something that might be a different way of pricing, and one that might be a way of pricing that you actually add more to your bottom line. I promise you, when I started doing it this way back in 2004, I got a lot of pushback from my clients, and they were paying me. But once they all started adopting this, none of them will ever go back to the old way of doing things, simply because they really can see how low they can go. They really know which crews are profitable and which crews are not. And it's really a situation that they go to a job with their eyes open and they can know exactly what they're going to bring home as long as it comes in the budgeted hours.
Yeah, so, and hopefully you guys can hear my audio better now. Sorry, my headphones were being kind of crazy.
Yeah,
I don't sound like a robot, right?
Yeah.
All right, sweet. Yeah, so what I was saying, you guys, is the other thing is if you don't actively have a financing organization in there, we'd love to get the opportunity to show you that as well. Again, nothing from Hearth has any sort of dealer fee associated, so it plays extremely well to the methodology we just expressed. And then two, when it comes to the payments, we also have a dedicated payment feature that's baked into our model or into our product. So you can accurately and securely request any sort of digital payment for both financing and non-financing company or customer, excuse me, and control the settings. So again, depending on what state you're in, you can put a setting that says pass that 3% to the customer. So, you know, you can create these incentives to push them toward ACH, you know, and avoid the 3%. If you do finance with someone, the other thing is you'll know that that person has the funding available because you've been alerted that, hey, that person has that money sitting in their account. You can force them into ACH and even turn off that ability to pay with credit card. So there's a lot of really cool things that you can do with our specific products. And, you know, being totally candid, this is one of, I would say, the most directly applicable webinars that we've ever done that can really truly move the needle on your business. We're going to share the recording with everybody that attended. Plus, for all of those who said they wanted that template from Ruth, we're also going to forward over your contact information directly to her so that she can reach out and help you guys. If you want more information on the course that Ruth is going to be offering as well, again, we put her website at the beginning of this presentation. Correct me if I'm wrong, Ruth. It's ruthking.info. Is that right?
That's my major website. Yeah.
Okay, cool. So if you guys want to get that access as well, here, I'll throw it in the chat real quick. It's www.ruthking.info. So like I said, we'll go ahead and share this out with everybody. Thank you so much for taking the time out of your day. Ruth, cannot thank you enough for everything that you've done. This is going to be one of many that we're likely going to do with Ruth, you guys. So if anyone is interested in attending these things in the future, also drop that in the chat window, and we'll keep these things coming. So thank you all for joining today. Ruth, always a pleasure. Any parting thoughts or questions? I know one of the questions that actually came in is, again, going back to what you talked on earlier. Well, what if I give the customer a cash price and the customer wants to put that amount on their credit card? I think we covered that.
We did cover that, yeah.
Yeah, so again, I think we're in a good place. If anyone has any last minute questions, we'll hang on for open Q&A for about, you know, a minute or two. Anybody, feel free to throw that into that chat question. It looks like we might have one or two in the question section as well. John asked the question, so can I accept credit cards through the Hearth app? Yes, you can. And you can accept those credit cards through the Hearth app, whether they used financing or whether they used financing with us, or even if they didn't use financing at all. Even if they are a cash buyer, you can actually send a payment request directly through our app. And it's all PCI compliant and secure, you guys. So, and it's all branded with your company name. Kathy, we were told we can't charge a fee for financing, that it had to be in the original price. Any ideas on that? I know there's state-by-state legislation that says whether or not you can charge those dealer fees within the price. The thing I will say is any state legislation, good luck proving that any markup that you provide on any pricing structure was directly related to whatever that option was. Most companies that I've interacted with in the many years that I've been in this space, especially from an operational perspective, will typically take their most expensive financing option in terms of that dealer fee, and then just put that in as a flat markup for every single one of their jobs that actively use financing, or they just bake it into their bottom line and just use that as kind of like sales discretion. So if they're not actively using financing, you know that there's, you know,
a different window, and they're typically trained on this, that, hey, if you have to discount that job a little bit to win the deal, you can do that by 12%, and if you exceed 12%, that's coming out of your commission check. So that's the way I've seen a lot of that handled before. But, again, it's state by state.
Yeah, and the federal law was actually enacted. Gosh, I can't remember. It was like 4 or 5 years ago. Citicorp, or who was it? MasterCard and Visa actually got it through that you do not. I mean, you can charge less for cash than you do for credit cards. And it went through the Supreme Court or something along those lines. That federally, it depends on how you do it. But Hearth's got the state by state, so you can look at it that way.
Yep, and then we have a couple other questions in here. John asks, aren't there financing companies that aren't charging a buy down, giving the customer a better interest rate? Typically, the way the buy down works is it's the only way for them to offering some sort of dealer fee or charging some sort of dealer fee is the only way to alter what rate that person receives relative to whatever their credit profile looks like. There really aren't a lot of companies out there that will look at a customer and say, well, you have a 700 FICO, so we'll be willing to offer you a 299 for 6 years. That 299 doesn't typically exist outside of like mortgage or something along those lines. Typically, a lot of loans are driven by either prime or LIBOR or some of those other indexes. But the reality is, right now, the lowest rates that you can typically get that aren't subsidized in some way, shape, or form are around like 499. That's where it is, at least today during this webinar, if you're watching this at future times. So again, there are some companies out there that will do those types of things, but the risk is incredibly high because it really messes with your algorithm, on approvals. So that in the most technical, nerdy sense is kind of the answer to that question. But the reason why we're able to do that is Hearth actually, in 2 minutes or less, without touching that person's credit and with no obligation to borrow, we can actually do a soft pull, understand exactly where that person's credit profile is, their FICO, any of the relative DTI or basic stats. And we can, given our 13 different lending partners, throw out a bunch of competing offers to try and give that person the lowest possible APR. Again, we've got a lot of different ways that we do that, but if you want to know more, we're happy to reach out. So that one was for John. We got another one for Paul.
Wait, before you do that, I want to add something to that.
Yeah.
The last thing you want is your bookkeeper coming to you saying to you, well, we charged Mrs. Jones $6,000, but we got in our bank account $5,223. So if you haven't put, let's say $5,200, if you hadn't put that $800 in there, then that goes directly against your profit. And why should you make and earn less because somebody financed? This way you don't see any of that stuff. All right. Yeah. Sorry.
No. That's perfect. That's perfect. So moving on, we also got Paul asked, Ruth, what do you do with helper or trainee hours? Do you add these to your overhead?
Well, helper or trainee hours already should be an overhead. Helper hours go in because your helpers are actually helping on the job. So their hours are actually billable. So if you say, if you have 2 guys on a job and you put 10 hours in there, that means the job's going to take 5 hours for 2 guys. If you have 3 guys on a job and you think it's going to take a day, that's 24 hours that's there. And that's, in our particular case, 24 times the $54 overhead cost per hour. So that's where your overhead comes in. If you've got 3 guys for an 8-hour job, it's 24 total hours. But if you can't bill, i.e. it's a trainee, then that's already should have been included in your overhead cost.
Yeah, that line item is typically going to be, is typically going to be your salary. I mean, it's technically a variable expense if it's hourly, but even then, that would typically be a line item on your books already.
Yeah, absolutely. And for those of you who are working in the field and also in the office, what you will do is you'll take, okay, I'm working in the field 70% of the time, and I'm working in the office 30% of the time. And let's say, for ease sake, that we can do off the top of our head, you earn $100,000 a year. 70,000 of that goes into direct costs and 30,000 of that goes into overhead. So that's how you would split that.
Yeah, awesome. So the next one is from Debbie Ann. She says, where or how do we determine the profit wanted per hour?
You have to do that and decide what you want. You know, my rule is this: it has to be at least what you can earn in a fast food restaurant, and obviously definitely not negative. I've had clients who look me in the eye when I ask the question, they're brand new clients, and they go, I don't know, can we start at $20 an hour? And I'm, yeah, you can start at whatever number you want. The key is to find out where you are now. That's the key. I mean, if you're earning, you know, $2 an hour right now, going from $2 to 20 is really kind of tough. I'd go to 10, which is still, you know, fast food wages, and then up it, you know, as you can up it. But you have to decide that number. I mean, you own your business. Nobody can decide that number for you. I will tell you a funny story with this. And so one of my contractors I work with, and he's like, I don't know, $20 an hour, you know, deer in the headlights there. And I said, okay, if that's where you want to start, that's where we'll start. And so we did. And then I get an email from him about, I'd say 30 days later, and he goes, is $100 an hour too piggish? And I just started laughing. And I went, no, what's going on? And so he said, I had this job where Murphy went to sleep. Everything went perfect. It took less time than we thought it would do. And I made a lot of money on it. And I got to give away a significant donation to my favorite charity. And I said to him, I said, you finally got it. And he goes, what? I said, the more you earn, the more you can give away. And so he consistently now looks at whether it's residential versus commercial, whether it's new construction versus replacements, and decides, he will not do anything less than $35 net profit per hour now. And some of the jobs with really expensive equipment on it, he does it $100 to $200 net profit per hour. So you can vary it depending upon the type of job it is. You can vary it depending upon industry. You can vary it depending upon the type of materials you have in there. So go play with it and see where it ends. That would be my suggestion for you.
And that actually also answers Tim's question, who said, do you recommend a different overhead per hour for different market segments, such as service versus replacement versus construction?
Yes.
And echoing what you just said, you can do whatever the hell you want. Really what it boils down to is, I think it's also customer perception. You know the appetite of the customer set that you deal with. This might also, and this is a question actually for me, is does this also even go as far as market by market or geolocation, where
yes, it does.
Certain segments and certain socioeconomic demographics have a certain appetite for a certain profit per hour?
Correct. And it also goes by seasonality. I mean, we'll take it one step further. I mean, when you're busier than busy, you can up your net profit per hour. And then when it's slower and you got to keep your guys busy, you know how low you can go. I suggest, for most of you, that you don't go under $20 to $25 net profit per hour, even when it's slow. But I have one contractor I work with who does a lot of new constructions, and some of his jobs he bids at $5 net profit per hour. And we watch those hours like crazy. But even, $5 net profit per hour is, six figures on the bottom line because of the number of hours that are in that job. So he's taken it and really slimmed it down to, $5 net profit per hour, but he knows what the dollar number is if we bring it in the labor hours. So you can play that game too.
Okay, that's great to know. And then Christy asked, what can you do with 1099 hours? That goes back to the same concept we were talking about earlier with that that variable cost of wage with, trainees, et cetera. You would calculate the same thing into your overhead, correct?
Yes, or, if it's a 1099, like a sub, like if you need a crane, or you don't do electrical and you need an electrical contractor, those are generally 1099s. And in the spreadsheet or in the template that I'm going to send you, there is a place for subs. So you put that number there. Awesome.
And then John asks again, he goes, I use Enhancify and I lose many customers because of low credit scores. I also have customers securing their own financing because Enhancify rate's too high. With the buy down price may go up because of the 18%, but they finance lower credit scores. Is that correct? Not always. What you're going to find is a lot of the places that offer buy down rates, and this is obviously kind of the Hearth specialty. Hearth actually works as low as a 500 FICO. A 500 FICO isn't going to see, a 499 rate. No. But there's a difference between that conversation with somebody with good credit, and most people tend to know where they're at. They know if they're south of 700, it's probably not going to be about whether or not they're going to see the best possible rate they can. What you're typically doing is you're shifting that conversation from I need the best possible value to I need access. And that's the major thing to do. Is it's all about also how you frame. So we work with people all the time, again, sub 700 all the way down to 500, where when you look at it, yeah, you might see a rate that is a little bit higher, but it's all about how you frame that to a customer. This is another cool thing about Hearth is, again, like I said, every customer starts with a pre-qual. We're going to take a look. I'll give you an example if we're talking HVAC. All right. I need a new unit. It's going to be about $7,000. Okay. That's for the base model and labor and all that other stuff.
Keep going, depending on where you are.
So what I can do is I can say, I need $7,000 for this project. Go through the Hearth app. The pre-qualification for us, like I said, 2 minutes or less, doesn't touch your credit, and there's no obligation to borrow. They can not only see what their rates would theoretically be, we pre-qual everyone, not for what they asked for, but the max that they can borrow. So if someone asks for 7, it might come back as, hey, you know what, Ruth, you were pre-qualified for 15,000. Now, what I can do as a sales rep is I can then upsell based on whatever you want. I'm not saying, hey, we're going to spend $15,000, but I can say, Ruth, we actually got you $15K. We're not going to use $15K, but there's a difference between the $7,000 job, the $8,000 job, and the $10,000 job. I want you to be the one to decide, knowing we've got $15K ready to go. Some of those rates might be low, some of them might not be. But the other thing that I have access to see is Ruth's credit profile. So I can also see that Ruth has roughly an 800 FICO. So if I'm managing some of these other financing companies, a lot of our customers use multiple lenders. But I can, without touching Ruth's credit, see where her FICO's at, how much she can be pre-qualified for. And if I have to use a buy down option, like a 0% or no payment, no interest, or a 299 fixed, I can pay that dealer fee, but I can also do that strategically because that's the only way I'm going to win that job. And there is always going to be that argument of, do I pay the fee or do I go to the next appointment and screw them? Like, the reality is you want to win the job, and if you suffer just a little bit because you have to pay that fee, all right, maybe you don't make that $25 profit per hour that you did on every other job. Maybe it's $5, but you're still net positive. So again, that's the kind of thing that you need to ask yourself, John, is it isn't necessarily one and done. It's have the tools in your bag to close anyone that you're going to deal with. And if you find that that isn't the case, do something about it. Ruth, does that help as well, do you think?
Yeah, absolutely.
Awesome, sweet. And then lastly, this is from Sean, and then we'll call it after this one, you guys, because we're way over time. Ruth, thanks for taking the extra time.
Oh, my pleasure.
It's how do you track your hours if you're using sub crews? They're paid a piece rate, and if multiple crews are used.
Okay, so let's assume that you're using subs, you will have to compute. Let's assume the subs are going to be 8 hours on a job every day. So, and there's 2 guys. There's a lead and a helper, so to speak. So you'll have 16 hours there. Now your overhead cost per hour is going to change a little bit. It's probably going to be a little bit lower simply because you're using subs rather than the guys internally. You won't have FICA, so Medicare, they should have their own workers' comp, hopefully. You won't be paying any of those benefits, so your overhead cost per hour will go down a little bit, but you still estimate the number of hours for that particular job, and that's what they're doing. So you can figure out what they're charging you per hour, which is, they don't think about it that way, but you can start thinking about it that way. If they're going to have 3 guys on a crew and they're going to take 8 hours to do this job a day, so you assume 24 hours, and that's how I'd put it in there.
Yep, and the other thing too, you guys, is what Ruth had said from day one. Unless you're brand new, wet behind the ears contractor, you're going to have historical data that you can reference. So again, if you have data from 2020, 2019, you might see a trend on, whether that's increasing over time, where you can apply that assumed incremental, call it expense. So if your labor is incrementally getting 3% more expensive year over year, you could theoretically take whatever you did in 2020, add that markup to whatever that is.
Don't use that word.
Sorry, not markup, excuse me. You add that incremental expense to it. And then at that point, it works within Ruth's model because you have that assumed figure. So again, there are ways to do that. The easiest is to take your historic data and extrapolate that word. So again, sorry.
Plug it in to see where your overhead cost per hour is and where your net profit per hour is, and that's your starting point.
Yep, sorry. It was like I just cussed in church.
I don't let anybody get away using the word markup. Sorry.
All right, all good. No, I appreciate it. That's there we go. So again, thank you guys so much for doing this. Ruth, thank you for staying on the extra 20 minutes afterwards.
My pleasure.
To answer our customer questions. And again, you guys, we're going to make sure that we reach out to you, not only share the webinar recording. The deck has obviously been recorded, so there you go. For any additional information on Ruth, obviously you can see what's on the screen. For anything additional with Hearth, obviously we've got some really cool stuff happening. We'll gladly reach out to anyone of you that joined today that aren't active Hearth members. And then beyond that, as you can see at the bottom, if anyone wants to proactively get any information on us before we reach out to you, gethearth.com or just give us a call. Honestly, we'd love to walk you through any of this stuff. So thank you again. Have a great rest of your week, and we will talk to you soon. Take care, guys. Bye.
See ya. Thank you.
All right. See you guys. Bye.
Oh, yeah. That'd be good. How do I get out of here?
In the top right corner. Noah, if you can hear me, you can end the webinar too, man.
Okay. So exit. There we go.
All right.
Thank you.
See you, Ruth. Take care.
All right. Bye.
Bye.